Right now, the median business-to-business software company spends $2 to acquire a single dollar of new annual revenue. This inverted math means the old logic of growth at all costs is functionally broken. Go back to 2020 and 2021, and the baseline formula was simple. Capital was cheap. Companies could survive massive cash burn rates by hiring aggressive sales teams and locking clients into per-seat license fees. This chart tracks the collision that changed the math. Over the last 5 years, rising interest rates intersected with a massive spike in digital advertising costs. Specifically, the price to run Google ads jumped 164%. Those external pressures drove the average customer acquisition cost to $1,200 per user, a level where many traditional sales models simply stop making sense. Under these conditions, rapid growth is no longer a marker of success. Without strong unit economics, scaling up simply accelerates the rate at which a company bleeds cash. To survive, operators have replaced raw growth with a strict discipline of capital efficiency. This dashboard visualizes the metrics that now determine survival. The primary gauge is the burn multiple, a measure of how much cash a company burns to generate a new dollar of revenue. The target for 2026 is keeping that number under 1.5x. Next to it is the Rule of 40. Revenue growth rate plus profit margin must equal or exceed 40%. Hitting these thresholds carries a massive market reward. Companies that pass these tests secure valuations 3 times higher than peers. These metrics force a shift in sales strategy. When it costs $1,200 to win one new buyer, relying purely on new customer acquisition becomes a liability. The most efficient revenue a company can generate comes from its existing users. In 2026, net revenue retention, how much more those current customers spend year over year, is the primary metric for long-term health. Across the industry, expansion revenue now accounts for 40 to 50% of all new recurring revenue. For most companies, extracting at least 40% of their growth from existing users is now a mathematical requirement for survival. Meeting these strict efficiency targets forced a structural redesign of how software is sold, starting with the way companies bill their customers. We can see that shift in this visual scale. The old per-seat pricing model, which charges by employee headcount, has dropped to just 15% of the market. Usage-based pricing is now tipping the scale. This pricing strictly aligns the vendor's revenue with the actual volume of work the software performs, rather than an arbitrary count of employees. AI pushes this efficiency even further. Through natural language programming, or vibe coding, startups build applications with minimal staff and push burn multiples to 0.8x, effectively generating more in new revenue than they burn in cash. The funding architecture has also changed completely. With venture capital equity valuations heavily compressed, selling shares has become a last resort for founders. Instead, they are turning to venture debt, an asset class that hit nearly $69 billion in 2025. Founders are leveraging their predictable cash flows to secure capital without giving up ownership. A winning software operator in 2026 is lean, usage-priced, and debt-funded. They bear almost no resemblance to the VC-dependent unicorns of the last decade. This restructuring has brought the market back. The BVP Cloud Index has recovered to its late 2021 historic peak of $1.92 trillion. But the foundation of this peak is different. It is built on structural efficiency rather than speculative projections. This area chart proves the shift. Across the entire public software sector, the share of companies operating profitably on a strict accounting basis has climbed from 31% in 2022 to 48% today. Look at this risk horizon. The AI driving efficiency introduces new threats over the next 5 years. Within the secular risk column, agentic AI threatens to migrate business logic out of traditional software layers directly into AI orchestration platforms. For modern operators and investors, growth for growth's sake is a relic. The defining truth of the next decade, efficiency is the new growth. Only those who master unit economics will survive the transition.